Hey, I'm Gene Goldman. Here's a look at the week ahead for the week of February 17th. So last week we discussed the market rule, don't fight the Fed. Since we're on a roll, let's talk about another market rule. This one is earnings drive stock prices. So basically, positive earnings can increase investor optimism and possibly lead them to buy the shares of those companies. On the other hand, disappointing earnings can have the opposite effect and investors become more cautious. As you see here, the good news is that since the start of this current bull market that we're in right now, so since October of 2022, stock market valuations, the dark line, and earnings, the light blue line, have moved hand in hand. That's great news. So looking at this week, let's discuss the current earnings season, what is expected for 2025 overall, and unfortunately, what macro factors could potentially hurt earnings growth. So starting with the current earnings season, basically, these are the results we're getting from the fourth quarter of last year. As you see here, about 77% of companies have reported earnings. Earnings growth is about 16.8% year over year. That's really good. Also, 76% of companies have beaten estimates. That's also a very good number. Looking at 2025, according to FactSet, earnings are expected to rise 12.4% year over year. Now, if we exclude events in Washington, like possibly reduced regulations, maybe tariffs, here are three macro factors that could possibly hurt 2025 earnings. First, if the economy proves to be stronger than expected, this creates possibly more revenue growth for companies. But as you see here, looking at the City Surprise Index, and this index is basically if a data point exceeds expectations, the line moves higher. If the data point misses expectations, the line moves lower. If you look to the far right, the data has become less positive. Not a good sign. Second of all, if interest rates decline, borrowing costs in theory also decline. This becomes cheaper for companies to finance projects. This is why investors are watching the Fed so closely. Unfortunately, the Fed seems to be on pause for some time. And number three, if a company's costs are falling faster or slower than revenues, this clearly affects earnings. You see here, using producer prices as a proxy for business costs and consumer prices as a proxy for sales, you see that producer costs are rising faster than consumer prices, also on the far right-hand side of this slide. So the big takeaway, earnings are very important to stock prices. Earnings have been pretty good this quarter, and they look good for 2025. However, there's some key macro factors that we have to watch carefully that could potentially impact earnings growth. Thanks for listening. For more information, please follow us on X at Cetera IM. See you next week. Thank you so much. Bye.